Good morning, all, or good afternoon, depending where you are. I'm Caroline Folene from Emory University, and I'm welcoming today Sarah Quincy from Vanderbilt, who's going to talk to us about banking in the Great Depression. So, Sarah, you can take it away. Actually, let me pause and just note to everybody to remember the rules of engagement, which are to use the Q&A to ask questions, and if there are some significant questions for clarification, I will interrupt Sarah. Otherwise, I will let her get going and present, and we will have some Q&A towards the end, and then we'll end at 12, at which point those who are really interested in discussing can stay on for an extra 15 minutes. Go ahead, Sarah.
Great. All right. Well, hello, everyone. Thank you so much for joining us, and thank you to Carolyn for moderating today. So I'm going to be talking to you about the Great Depression in the United States. But to just start, I want to give you sort of some motivation here by comparing the scope of the Great Recession and the Great Depression, our two big financial crises in sort of the history of the United States, compared to both the current sort of COVID crisis and other recessions in the United States. And so what I've plotted for you here are just industrial production indexes relative to the start of the recession for a variety of US recessions. And you'll notice, right, that both the Great Depression and the Great Recession, even 5 years after the start of the recession, we don't see a full recovery in industrial production, which is in marked contrast to a lot of other US recessions. So these are the ones that are in light gray that I don't label separately, and even sort of the current one, which is, obviously its own very interesting, very different thing. And so this kind of gives us a sense, right, that we should think about financial crises as different than regular recessions, both in terms of sort of the steepness of the decline, right? These are larger contractions in output relative to most other recessions. But even after 5 years, we're still not seeing a full recovery. And in fact, when we try to break it down, just looking at the Great Recession and the Great Depression, we see that years and years and years after the end of the crisis, we're not recovering back up to pre-recession trends in, for example, GDP. So that's what's going to be on the left over here. You'll notice that building up to the crisis, we see high GDP growth. On the right, we also see high credit growth. This is something that's been well established, that financial crises are associated with these credit booms. But then once the crisis itself starts, once instability sets in, we see that there's a contraction in output, and we see actually a divergence between that pre-recession trend and our post-recession growth. So it's not only that recessions, financial crisis recessions are severe, it's just that we also see these massive sort of welfare costs associated with these really prolonged, slow, weak recoveries. This is true in the Great Recession. And then in red here, you'll see the Great Depression, which makes everything look worse. So these figures are supposed to sort of motivate the key in this paper, which is to say, why is it that losses in financial intermediation are so important for understanding the growth of economic activity over a long period of time, right? It's not just a simultaneous effect, but we see for many countries in many years that periods of financial crisis are associated with both these severe recessions and slow recoveries. And so what I want to do in this paper broadly is think about how disruptions to financial intermediation, I'll talk about what I mean by that in a little bit, how they affect sort of local growth, and then try to understand why. The tricky thing is, right, access to credit and banks' lending decisions are very rarely randomly distributed. We also don't have a lot of crises with which we can sort of disentangle these things. Specific to the US Great Depression, it's hard to trace these things out because of the structure of the US banking system and the lack of data that is going to be disaggregated enough to distinguish between different areas with different banking markets, and at a high enough frequency that we can actually trace out differences in the recovery. So I'm going to be overcoming, hopefully you agree, these challenges by isolating a local credit shock based on access to a very unusual bank in the United States, what is now the Bank of America. And sort of freeze access to this bank before the onset of the Great Depression, and then trace out cities with and without this bank and see how their economic activity responds to changes in local credit. So the key thing here is that this is going to be the Bank of America, which, unlike basically any other bank in the United States, was actually located in lots of cities in the state of California. So I want to think about this from a sort of a broader perspective to say, how do we think about the decision of this bank to consciously change their policy and be more active in lending during the financial crisis of the early 30s, affect those cities, and then try to understand why. And this can hopefully give us some guidance in a more general context, but I think in particular for this audience, it's important to think about why was the Great Depression so bad, both in terms of the 1929-1933 period, but then why was the recovery so uneven throughout the rest of the 1930s? So as I just said, I'm going to be thinking about this in the context of the Great Depression and in the state of California. So I'm going to be looking at places with and without a Bank of America branch in 1929. And this is going to be really useful for thinking about the causal effect of financial intermediation, because the locations of this bank were were fairly sort of exogenously determined because of a variety of fun history things that we'll talk about, which hindered their ability to select into particular cities. So they lock in this network before the onset of the Great Depression, and then during the Great Depression, cut lending less than the median California unit bank. And so I'm going to be able to trace out the effects of this headquarters lending decision on these local areas using a variety of data that I've cobbled together from a lot of existing sources, but also a whole bunch of archival things that I was lucky enough to find, both at the city level in terms of banking markets, but also local labor markets and proxies for local economic activity. And then to sort of take a step back and think about why we see these effects, like why is financial intermediation so important? I'm going to use the 1930 and 1940 US censuses to construct a linked worker level data set to trace out why it is this is happening. So to give you a preview of the results here, cities that were in the Bank of America network. So in this context, the big bank is the good bank. And we're going to see that cities that had access to this bank that continued lending at a higher level than other banks are going to have smaller contractions during the crisis, right? This is a validation of everything Ben Bernanke has told us, right? Like that financial intermediation matters. But I'm going to show that it's not just that it matters during the crisis itself, it brings about an earlier recovery and a stronger recovery. And so this is going to be one thing that we can see because of the panel of data that I've collected at the city level. And so credit has these large persistent effects, both in terms of softening the recession and bringing about earlier, stronger recoveries. And then to understand that, again, I turn to these linked census data. And what's interesting is it's not just that local economic activity itself is different. The structure of the labor markets are. Places that had more credit are shifting out of agriculture and into retail and service employment, stuff that's specifically non-tradable and uses a lot of white collar, high education work. And so that's being driven by a movement of high education people with more than a high school education, into jobs that are white collar in Bank of America places, specifically in these non-tradable sectors. So this skill biased structural transformation channel is something that I haven't seen in other parts of the literature. And I show that this can explain most of the wage premium that is associated with having a Bank of America branch in 1940. So this contributes to a couple of different literatures. I'm showing sort of the importance of the intersection of financial intermediation, structural transformation, and human capital for understanding the evolution of economic activity during and after financial crises, which I think speaks to a modern literature on sort of the importance of credit and the real effects of credit, partially motivated by the Great Recession, but in kind of specifically thinking about the Great Depression, I'm linking together both the recession and the recovery and thinking about the effects of banking on both halves of the 1930s and trying to trace out how it is that we see these differences that last for a long time. And I'm going to argue that bank branching is a big part of that difference that I observe. Okay. So I want to get a little bit into the fun historical context stuff before getting into identification, and then I'll show you some city level results and finally some worker level results. So one important thing to know as we're talking about California in the 1930s is that it's not a Britain-sized economy at this point. It's the 6th largest state in the United States by population. The structure of its economy actually looks a lot like the average in the US. So there's a lot of manufacturing, there's a lot of agriculture, there's a lot of services in a way that matches what's going on with the rest of the United States. So probably unsurprisingly, like the rest of the United States, per capita personal income, which is the sort of available state level economic activity variable that we have, falls by about 45% in California during the financial crisis period, right, 1929 to 1933, which is fairly similar to what we see in other parts of the United States. And one sort of thing to keep in the back of your mind, right, and this is a Simon Kuznets thing, is that the U.S. pauses its structural transformation during the 1930s. So just like the rest of the United States, in California, there's this pause and the shift out of agriculture on average in California, which is just in and of itself interesting. So despite the fact that California has a pretty similar economy to the rest of the United States, it has marked different financial regulation. So most California banks are like other American banks, right? So that in the United States, we're talking about one location in one place, traditional unit banks. There's no banking across state lines in this period, but California, through, again, a series of twists and turns that I'm happy to talk about later, technically allowed branch banking across different cities, which is unusual in this period, but it was heavily restricted. And this is going to be important because the restrictions here are sort of hard to interpret and led to a lot of noise in terms of who was allowed to branch bank and where they were allowed to branch bank. This is going to be important because it turns out the people in charge of choosing which banks were allowed to buy other banks and convert them into branches had a lot of their own agendas and a lot of their own thoughts and a lot of their own power. So there were a lot of restrictions on what we would call de novo branching, which is what we have a lot more of now in the United States, where you can, you can apply for a permit and you can open a brand new office of your network where there was never one before. Instead, in this period, you're usually going to have to purchase a unit bank. So a unit bank is going to have to agree to sell themselves to you. And then you're going to have to turn to the bank regulator, the state banking department, and say, may I please turn this into a branch of my existing network? The tricky thing, right, so is that there weren't a lot of rules about how you were supposed to convert these things or allow these things to be converted. So the quote at the top of this slide is actually from the chief regulator of the California State Banking Department, talking about his own employees' attitudes towards the Bank of America. They're going to be anti-Bank of America for a couple of reasons. There wasn't a lot of there were a lot of people who thought maybe bank branching was going to destabilize the banking markets both locally and across the state. So there were a lot of economic reasons. People weren't sure that it was going to work out well. They were afraid that what was going to happen is that people were going to take money out of rural areas and just lend in urban areas. So they weren't sure it'd be good for sort of individual people. There's a strong nativist component to this. So like there's like regulators who are calling the founder of the Bank of America, A.P. Giannini, racist slurs in the press. A.P. Giannini was Italian American. Bank of America was initially called the Bank of Italy. And people were like, well, this guy is an agent of the Pope, right? He's out there to sort of conquer California for the Vatican. These are things that people actually said. And this is going to lead them to be very hesitant to allow a bank that actually wants to open branches across the state to approve these branches. They don't really like approving them. Again, some of this is sort of like economics. It just doesn't seem like it's a good idea for stability. Some of it is straight up nativism, and some of it is self-interest. The people in charge of regulating these things are competitors of the Bank of America. So what this means is Bank of America is thinking about this idea that they want to be everywhere. They want to be your department store for banking. They want to be absolutely everywhere. They're hindered by state regulators, sort of anti-Bank of America attitudes, and they would like to become a nationally chartered bank, but that's not possible until the passage of the McFadden Act in 1927. And so what ends up happening is that the Bank of America acquires a lot of branches right around the passage of the McFadden Act. And this is going to come from two things. One is there's a new state bank regulator in January 1927, and the passage of the McFadden Act happens in February 1927. So what you can see here is that they basically build their network in that tiny window. And they have to go around from unit bank to unit bank to unit bank, and try to get them to sell to the Bank of America in that really narrow window of time. And so it's not that Bank of America is not trying to maximize profits, but they're really constrained by the attitudes of the people around them. And that's going to be important for trying to understand why it is places that have a Bank of America and those that don't are pretty similar on sort of pre and post Bank of America expansion observables. So what you can see here is that Bank of America is unique in the size of their expansion, and that this isn't growing the number of cities that are going to be having a Bank of America. So I'm going to be comparing the cities that have a Bank of America to those that don't. And so it's going to be roughly in the final sample, something like 100 and something in treated and 100 and something in non-treated. Okay, so after they have this expansion, which is tied to the McFadden Act, Bank of America is continuing to lend sort of at rates that are similar to their competitors. Their loan deposit ratios are moving along in a parallel line. But what happens during the onset of the Great Depression is Bank of America issues this kind of ad. They have this campaign, the Back to Good Times campaign, where they say, we are opening the financial floodgates. We are willing to lend even though other people are not. And they have A.P. Giannini go around, tour the state, and they're really trying to sort of make credit available. And you can see this is going to be at the city level that this is true. I want to just highlight this for a second. So these are city level, the growth rate in city level lending between 1929 and 1934. And so here I was actually able to find estimates of Bank of America's lending at the branch level in 1929 and in 1934 by bringing together data from congressional hearings and stuff I found in the Fed archives, which is going to give me branch level balance sheet information from call reports. And so what this means is that I can actually show you here that there's a change in Bank of America's lending that is different than non-Bank of America treated places lending, right? So what you'll see is this is the distribution of those city level lending estimates sort of across all cities. And you'll notice that most non-Bank of America places, even if they don't have bank failures, are cutting lending by a lot more than non-Bank of America places. And so this is going to make credit more available, right? This is like a classic sort of financial intermediation thing where places that have a Bank of America experience a differential sort of positive shock to places that don't have a Bank of America. So I kind of just mentioned this, but given this sort of this shock, I wanted to give you a little bit of history there. I want to talk a little bit about the data that I'm bringing together. So because of the historical nature of the project, right, I can get bank level balance sheets from the regulators. So the comptroller of the currency is for nationally chartered banks, and then we have the state bank departments balance sheets are going to be in their reports. The stuff that's highlighted in red is stuff that I found and have digitized and have brought to this project. So I found branch level balance sheet information, which is going to let me construct the information I just showed you and also test the key assumption here, which is that Bank of America is lending in places that are in their network in ways that are orthogonal to those places' pre-depression characteristics. And then I'm going to be able to trace out those effects using these economic activity variables, which is going to be a property, sort of city level property value per capita measure, which is going to be coming from tax reports. And then finally, I'm going to be constructing a linked data set. So I'm going to follow workers from 1930 to 1940, and then match that to the city level estimates that I have for you here. Okay, one other fun thing to note, so this is another Bank of America ad, is that they are lending widely. So the title of the paper is actually in reference to one part of Bank of America's strategy, which is to lend to people who are not traditional banking customers, that loans for the little fellow, but they're also going to be lending pretty widely in terms of which parts of the California economy they lend to, right? So when we're thinking about who the treated people are within Bank of America places, it's going to be a pretty broad swath of the population. But for me to be able to use this, I need to show you, I can wave my hands and say whatever I want, that Bank of America is making loans in these places, and they're not picking places that are already better, right? That's the identification problem. We don't want to be looking at places that were already on a better trajectory and just happen to get better credit because they were on a better trajectory. And I'll show you guys a little bit on that. And the first way to see this is a visual sort of balance test here. This is a map of California. So here is going to be San Francisco. Here's Los Angeles. This is the Central Valley, which is where like all of your almonds are from now, but is historically always been sort of an agricultural mainstay in the state. And so what you'll see is that places that have a Bank of America, those are going to be the bluish circles on your screen, are going to be in relatively similar places to those without a Bank of America in 1929. So this is going to be true both in terms of location and population. So any of the things that you think are going to be maybe only happening in agricultural areas or only happening in the northern half of the state or whatever, southern half of the state, whatever it is, these things are going to be balanced across treatment here, right? So Bank of America is expanding broadly, right? They are actually all over the whole state of California, but they are not expanding into places that look different on these two things. Of course, I can show you that this is also true in a numerical sense. So I can show balance on a variety of demographic, economic, and banking variables, both before and after Bank of America's expansion. And this is going to be coming again from the fact that they are pushing to expand in one very narrow window in particular, and they're going to be pretty constrained by the attitudes of the regulators who have to approve these things, and the bankers who are willing to sell their banks to them. And so, maybe in the Q&A, if people want to talk about it, I can give you more information here. But the key thing is that both before and after expansion, Bank of America places and non-Bank of America places are going to look the same. The one exception is going to be population. And a lot of that actually is going to be coming from the fact that Bank of America is in the biggest 20 cities in California. A lot of these places serve as bank headquarters. After the passage of the McFadden Act, there are different rules about expansion in populous cities. So I'm going to be dropping those places and only focusing on places that have populations under 20,000. And once I do that and I control for population, everything looks lovely and balanced. So given that, I need to show you, right, that the Bank of America is actually lending in these places. It's not that they're doing what regulators feared would happen and taking money out of rural places and just lending it in Los Angeles. They are making money available in these places with populations under 20,000 people. And so if you don't add any controls, what you'll notice is that on average, cities are going to be cutting lending by something like 60%. That's seems like a lot, except for the fact that we're talking about a period that we're talking about the early 1930s. And this is going to be markedly smaller, a third smaller, if we're talking about places that had a Bank of America branch by 1929. So before the onset of the Depression and the change in this policy. We can start adding controls for things like 1930 population, sort of the structure of the economy. So things like the agricultural employment share, the manufacturing employment share, anything like that. And even if we add in banking variables, so things like what's the log amount, what's the total amount of lending in these cities in 1929? Things like what's the loan deposit ratio? One set of, I could add another column here and add in percent changes in lending from 1922 to 1929 or anything like that. All of the results are going to go through. Places that have a Bank of America are going to have markedly smaller contractions in lending in ways that are going to be unrelated to their 1920s growth trajectories. So this is going to lead me to my first set of results here. So I can show you here, this is going to have my pre-trends test, but I want to show you that places that had a Bank of America are going to have both smaller contractions and stronger recoveries. And the way that I'm going to be doing that is by estimating a series of local projections starting in 1923 and rolling all the way forward to 1940. And so what that's going to let me do is I'm going to say, let's see if a place had a Bank of America by 1929. It doesn't change the results if I say, when did you get a Bank of America in terms of the treatment, which makes sense, right? The deviation is happening post 1929 in policy between Bank of America and non-Bank of America places. But what we see here is the coefficient on this beta 1 for every horizon from 1924 or 1925 all the way to 1940. And I'm going to be controlling for population and 2 lags of this economic activity variable. And so what you'll see are this series of beta 1 coefficients along with a 90% confidence interval. And so what you'll see is that throughout the latter half of the 1920s, It's going to be an imprecisely estimated zero here. So the largest difference between a Bank of America and non-Bank of America place is going to be about 0.04 with a standard error of 0.05. Right, so that's going to be noisy and is statistically insignificant. But what happens after it's the vertical line here, it's 1929, is we start to see that Bank of America places are going to be growing faster or having a positive difference between in their economic activity compared to their untraded counterparts, right? So places that did not have access to this lending policy. So during the crisis itself, we're seeing that there's a positive difference. What's interesting is this compounds then after the onset of the recovery, right? So places that have the Bank of America continue to grow at higher rates even after this, the end of this policy. So after 1934, there's going to be a much smaller difference between Bank of America's loan deposit ratios and other banks' loan deposit ratio. This is really a crisis era shock. And in fact, if you do a different version of that local projection, right? And you say, let's just see what happens if I'm going to drop the dummy variable and here just have two mutually exclusive dummies, one for Bank of America, one for don't have a Bank of America in 1929, and demean all the things that you need to demean on the right-hand side to make this possible. You can see that this difference in the growth rate of economic activity is coming from, again, a smaller contraction here. So during the crisis itself, these places are going to have smaller contractions. That's what we're going to see sort of pre-1934. And then it's going to be an earlier recovery. By 1935, Bank of America treated places have actually grown relative to their 1929 levels, right? That's what these differences are telling us. These are going to be differences relative to 1929 in this variable. And that's going to continue to grow basically from 1935 all the way up until 1940. I should say, right, I'm going to stop in 1940 because by the end of 1941, the US is going to be involved in World War II, and California is going to be a major site of that mobilization. So I'm going to stop before that. And it's also going to let me map these results to the linked census data, which are going to be measured in 1930 and 1940. So what this tells us is that Bank of America places are going to have smaller recessions. So again, this matches up with what we know. Financial intermediation matters for the size of the crisis. But it also is going to matter from the perspective of the timing of the recovery. Non-Bank of America places are going to be converging back up to, their 1929 levels of economic activity around 1940. But it's also going to be this coming from this sort of earlier recovery, but also a stronger one. Okay, and this is robust, we always should be skeptical, right? So this is not being driven by specific differences in terms of pre-depression labor markets or growth rates or anything like that, or the size of the place. And so that gives us confidence, right, that this is truly coming from differences in Bank of America's lending policy, not selection into types of cities. You may also wonder, right, how much of this is coming about because of the differences between Bank of America and other kinds of Bank of America, other kinds of banks. This is not being driven by sort of the type of charter that banks have, or sort of exposure to the discount window or anything like that. And in fact, right, we can actually use pre-Bank of America expansion differences, characteristics to predict whether or not you get a Bank of America. And use a propensity score matching technique and still get the same results. So places that look similar before Bank of America expands, one gets a B of A, one doesn't, we're still going to find the same results, which again should give us a little bit of confidence that this is really being driven by this financial intermediation difference. Okay, so given the fact that there are these persistent differences from 1929 to 1940 in terms of property value, average property values, in Bank of America versus non-Bank of America places, I think it's natural to say, well, what else changes? We tend to think that after recessions, right, we are going to bounce back to some trend, right? We don't usually like to think of there being these persistent reallocation differences between places. But that's what we find, right? If you just look at the changes in city level employment across sectors between Bank of America and non-Bank of America places, these changes are going to be between 1930, so the sort of the pre-depression census, it's measured in April of 1930, and April of 1940. What we're going to see is that this is just the average difference with a 95% confidence interval. There's nothing else going on here. Places that have a Bank of America are going to have smaller commodity sectors. This is mostly going to be driven by agriculture. And compared to non-Bank of America places, they're going to be increasing their employment in trade, which is going to be largely retail. But in general, right, we're seeing that Bank of America and non-Bank of America places are increasing the size of manufacturing and construction, lowering their transportation, utilities employment, and maybe lowering their service employment. You'll notice there's no difference in government employment here either. These results are not being driven by exposure to the New Deal. Anecdotally, that's because the one part of this is that, so AP Giannini, the founder of Bank of America, was like briefly very good friends with FDR, but like by, I don't know, April of 1933 was no longer good friends with FDR. So you could imagine that's not like an incentive to allocate New Deal funding towards Bank of America places. So we're going to see the shift out of agriculture and into sort of retail on an industry level. Non-Bank of America places are on average, this isn't precisely estimated, but there's like no coefficients here. They're going to have larger commodity sectors, which again is in line with what we see for the rest of the country. What's interesting is this is matched by a movement. Again, okay, Bank of America places have smaller commodity sectors. They're exiting farming. That makes sense. But where are these people going? They're moving into, we're seeing increases in professional and managerial work, some into sort of crafts and operative work, which is going to be largely in the manufacturing sector, and service work. But this is going to be a very different, if you look at the differences between Bank of America and non-Bank of America places, white collar sectors, we'll see that Bank of America places are going to experience growth in this and non-Bank of America places are not. Now, it turns out you can do this in a regression and at the individual level, and you're going to see similar results. So I just want to kind of tell everyone what these regressions are. And so if you look at sort of what industry people are working in 1940, as a function of, does the place you're in 1940, were they treated by this Bank of America policy? So do they have a Bank of America by 1929? You can control for the nice thing about linked data, right, is that you can observe things about people before the Great Depression, or as close as we can get. So controlling for some stuff in 1930, some place level characteristic information from 1930, and then I can include county fixed effects. I'm going to be showing you these city level results that I just showed you are going to be matched by estimations where I actually, look for this beta 1, right? What's the difference in the kind of work people do or your average income in 1940 based on whether or not this place had access to this financial intermediation shock. Okay, so when we turn to the individual level results, right, we can include this Bank of America proximity thing, this beta 1. But what's interesting is, so the jobs that people are moving into in the city level are the only sectors where the median worker, both in the United States and in California, has a high school diploma. So these are going to be the high education jobs of the time. And what you'll see is that places that have a Bank of America are going to have more people working in skilled occupations, these high education occupations, and working in the non-tradable sector. What's interesting is these effects are at least doubled, right, for the non-tradable sector, more than doubled here, or matched and then doubled for skilled occupation, by workers who are in a Bank of America place. So they have these smaller recessions, stronger recoveries. This reallocation is being driven by people with higher education. They're moving into the higher education jobs. So you can interpret this as saying that places that have a Bank of America are increasing sort of the density of human capital work in human capital intensive jobs, right? Skilled occupations are going to have more people with higher skills in them. And we're going to see that these jobs are going to be increasingly focused on non-tradable work that is both locally produced and consumed. So there's going to be this sort of reallocation of skilled work, both in terms of who you work with, right? Like you work with other high education people, but also the kinds of work you do are going to be different. So this suggests, right, on some level that the differences between Bank of America and non-Bank of America places, these persistent differences that I argue are coming about because of financial intermediation, are being matched by a reallocation of workers, right? This is a continued structural transformation. No longer, Bank of America places are not growing in agriculture. They're growing in these human capital intensive ways. As it turns out, places that have a Bank of America are going to have higher wages in 1940 on average, even when you're doing this at the individual level. So this is going to tell us that these are at the individual level, so I can control for a bunch of observables about individual people. But on average, right, places that have a Bank of America branch in 1929 are going to have 10 log point higher wages in 1940. Now you might think, okay, well, maybe this is being driven by sort of stability, right? Having access to a bank that continues to lend to both households and firms, maybe that just means that they don't have the same employment crisis, right? I don't have unemployment numbers throughout the 30s. It turns out the California Bureau that was in charge of that ran out of money in like 1931. So I can't track that. So maybe it's being driven by employment stability, right? On the job human capital. And in fact, there is evidence of this. And you can see this at the sort of industry by industry level as well. Places that have a Bank of America people are going to have higher wages if they stay in the kind of job they're doing. However, these effects are much smaller than if we think about whether or not people are working in the skilled non-tradable sector. So that's the intersection of white collar and non-tradable work. When we interact, do you have a Bank of America in 1940 with the share of workers in your town who are in this skilled non-tradable sector? We see that is going to be positive and fairly significant here. This is right on the border between having 2 stars and 1. And this is going to be large. So the nice thing about the data here is that I can horse race these things, right? How much of this is being driven by the stayers, and how much of this is being driven by the movers or the people who are going to be reallocating, right? If I think that what's going on here, and what I do think is going on here, is that we're moving in Bank of America places, we're moving high education people into high education jobs that are going to be, really focused on the local economy. I can compare that to whether or not it matters that people stayed in their industry. So not only can I have, do you have a Bank of America or not? And do you stay in the sector you were in? Are you in the same sector in 1930 and in 1940? I can horse race these things. And what I'm going to see is that, the Bank of America effect is totally gone. There are benefits to staying in the same sector you were in, which I think hopefully makes sense. Like there is the real rewards to sort of being in the right thing or on the job human capital. But we'll see is that the staying in your sector effect is going to be substantially smaller than the staying in a bank, than do you have a non-tradable sector share, and are you in a Bank of America? And this is going to be in fact negative in some cases, not driven by the people who are staying in the non-tradable sector. So this suggests that what's really going on here is that the reallocation of workers towards skilled non-tradable work can explain, as it turns out, almost 90%, if you actually do the back of the envelope here, 90% of this wage difference. Right, so we can think about these persistent differences in Bank of America and non-Bank of America places, which were not there in 1930 at the city level, as being really driven by this skill-biased education channel, right? This movement of people into non-tradable work who are high human capital. So I see I'm right at 40 minutes here. So just to wrap up, I see this paper as using a different source of variation than maybe has been used in the past to identify financial intermediation, and a bunch of new data sources and traditional data sources here to show that financial fragility really matters for both phases of the Depression. Having access to a bank that lent, a large branch network, as it turns out, provided more credit stability during the crisis, but it also led to more economic stability and actual growth throughout the 1930s. And I argue this is coming about because of this labor market reallocation channel, which suggests, right, that we need to think about the intersection of human capital and structural transformation when we think about why it is places are evolving differently during financial crises. So I'll stop there, and I'm happy to hear people's questions. Thank you.
Okay, thank you. We have one question from Chris Colvin. Can you show us your analysis of B of A's expansion? You mentioned this in passing.
Mhm.
He's surprised that the acquired unit banks are not systematically different. So have you been able to get a hold of any archival evidence that describes their acquisition strategy?
Yeah, so I should say I owe a debt to Mark Carlson and Chris Mitchner's work on bank branching in the 1920s, which actually is what started me off on this path. In their paper, they show there are places that, unlike other branch networks, B of A is not substantial, like selecting into places that are markedly different, except on the population front. And that if you look at sort of the 1922 characteristics of these places, in these banks that are acquired, they're not that different. So in terms of archival evidence, it's really interesting because like the B of A people on some level are puzzled why people finally relent and sell their banks to them. They're like, we've been knocking on this guy's door for 10 years. So from an archival context, they say that the state banking records, I went and I found, as much as I could from both the Fed regulators and the state banking regulators. And what's interesting is like, they're really idiosyncratic, right? They don't like to give a lot of reasons for what they're doing. But what you'll see is that so I can go and I know this is like bad etiquette to sort of click through too many things. But what you can see is that just too many things. There's no real trend in terms of it, in an event study framework, like when you have a Bank of America, kind of what trends in economic activity or population or anything look like. But what you'll see is that if you try to predict, do you have a Bank of America by 1929 or do you not? What you'll notice is that there's a lot of overlap. And this is using sort of city level information, which includes things like population growth rates in agriculture, some banking information, like how many loans do people have in 1929. You're not going to see a lot of stuff. So there's a whole appendix in the paper with a lot more information on this because I think it is really important. But I think the reason that you're not going to see a lot predicting what B of A is doing is specifically this, like they have like 6 weeks to beat out the clock, and they just need to have to buy these banks by the end of February 1927. And so that's a lot of what's going on here. And before that, before you're worried about beating out the clock, they had people who were their competitors trying to shoot them down.
Okay. The B of A dropped there again. Is that these are losing? What can you clarify?
So the B of A dropped these are the top 20 cities. And so what you'll see is that basically every city that's in the top 20 by population, like definitely has a bank, like they all have a Bank of America. And if you try to predict whether they have one or not, they do. The probability of selection is usually 1. So I do a version of this. I do the local projections. So from 1923 to 1920 to 1940, using just this overlap in a propensity score matching thing to say, okay, let's think of places that should be the same on observables, that the same information that everyone would have had at the time, and use that, and all of the results are going to go through. So, I mean, I interpret this as saying, right, in a statistical way that the sheer chaos of the acquisition process and the push and pull between all of the different people here is going to lead these places to look fairly similar. So I want to say, like, it's not that Bank of America is not profit maximizing. It's just that they're constrained in how they're profit maximizing. They're like, we want to be everywhere. And everyone around them is like, absolutely not. So they're just trying to be in as many places as they can, which limits their ability to be in as many profitable places as they can.
Well, that's interesting. So Eugene White has a question, but I have a question. I'm going to take my prerogative as
sure.
Because it's related. If you go back, I mean, it doesn't have to be, you don't have to go back to that, but
yeah.
For matching. And one thing I was wondering is if you had thought about using some kind of synthetic control method to try to, because you're doing a difference in difference, but you have some perhaps not parallel trends prior to the treatment. And I'm just wondering if you had thought about using synthetic controls or a method that would try to
yeah.
for the retreatment trends?
So the tricky thing about synthetic control, so that's what I view the propensity score method as maybe the best way to do that. Let me skip forward to here. So what I can do, right, is I can say, let's look at I can show that these things are like the same if you look at places that are high and low growth during the 1920s, high and low population, sort of as a very simple sort of non-parametric way to try to get at that problem. So the issue with synthetic control here is that I don't, it's going to be tough to construct a counterfactual, for example, using places in other states where I can actually get the same kinds of information. So the propensity score matching technique is going to be my way of constructing something like you're saying, right, where I can actually go and do that. And once you do this, right, it's going to be flat before this, and you're going to see that the same pattern is going on there.
Oh, okay. So your comment suggests maybe the answer to my follow-up question was going to be no, that can you compare to other cities? And this is going to segue into Eugene's question, where you could you talk about other states as controls for your difference in difference, because California is not the same as the rest of the country.
Yeah, so it's going to be, I mean, I take the point that, you know, only using one state means that you're not using the whole country. So I don't have the graphs in here, but I made these graphs at one point where basically no state has the kind of population growth and expansion that California does over the first half of the 20th century, other than like California at all, other than Florida. And Florida has their own financial crisis that comes before 1929, right? And so it makes it a difficult comparison if you're trying to think about sort of economic trends. But one thing I do want to emphasize here is that California, I know that it's like, I'm from California. I shouldn't be saying this, like we're very pro state exceptionalism, is that it really does look a lot like the rest of the country in a lot of ways, other than banking. Is particularly in the setting I'm looking at. But the thing I worry about, right, by using other states is that one, the data sort of at the bank level is not necessarily as thorough. Not every state banking regulator had a former school teacher in charge of it to sort of construct these detailed level records. But I do think, right, that non-branched places, non-treated places in California are having sort of, if you compare what goes on in the non-B of A places in terms of lending or sort of in terms of sort of the 1930, 1940 changes, they look a lot like the rest of the country. So I don't think it would be appropriate in a lot of ways to say that places in other states would be a good comparison group in a very clean way, even if I had the data. But I take your point, right? I am using one state, but I hope that sort of using this within state variation still speaks to some of the broader questions we have around the Great Depression.
So, okay, question I'm just joking. To your point about California exceptionalism, as a former Californian, Eugene White, who I believe is originally a Californian,
yeah.
Says or asks, can you aggregate the effects of B of A branches for the total effect on the California economy? And this might allow you to compare California to other states. So trying to give kind of the real overall significance of the impact on the economy, that quest to move beyond, I think maybe what he's getting at is, moving beyond the coefficients and statistical significance.
Sure. Okay, so that's interesting. I could do this from 1930 to 1940, like using the census. So these economic activity data, I was very excited to find something that exists at the city level annually throughout the 1930s and 1920s. So I can do all the pre-trend analysis stuff. That part I can't do for anywhere else because this is from a state tax authority. But I could think a little bit more about sort of how I would compare this. I think the thing that keeps me from doing it is trying to think about, I'm sort of doing this explicitly as like differences in financial intermediation. And the way that I think that I can get at this is by dropping places like San Francisco and Los Angeles. And to compare to the rest of the country, I probably have to think a little bit more about what's going on with those places. And I'm collecting a bunch of information to be able to do that in a separate paper to think about what's actually going on, nuts and bolts with branch networks here. So I think it's a really important thing. I'm not sure that this paper is going to be well suited to answering that question in a way that maybe is satisfying to Eugene.
Well, Eugene is not easily satisfied, but he does ask good questions. So Nathan Sussman has a question for you.
Hello, Sarah. Very interesting paper. I'd like to pick up on this more on this identification and so the contribution of Bank of America is independent from other things. So first of all, maybe I'm expressing the views of a dinosaur in this profession, but so I think that it's not always necessary to have this perfect natural experiment or perfect identification to show what you're showing, that bank intermediation works and is effective. I mean, it obviously could make the story better, but if you're, on the other hand, I think if you're pushing this too far, it might create the opposite reaction. So I'd like to ask you a little bit more about this identification, because you said that the main difference between two points here. The main difference is city population. Now,
Sure.
If you're coming from sort of the agglomeration literature, the Krugman literature, so you would expect that these cities also, so once they have something different in terms of these agglomeration effects, especially in terms of human capital and a diversity of jobs and all kinds of other things that might not be captured by, and that could affect the decision of Bank of America, because they're saying these places have more opportunity to diversify and lower risk because they are larger pools of people with, I don't have to follow all this, but it's
No, yeah. Yes, I've done this and it's fine. So in the paper, there's a balance table in the main text, which basically is like, let me show you that the employment shares are the same across Bank of America and not Bank of America, because exactly, right. It's not like to assume to say that that it's just population or anything like that that matters is absolutely not addressing those things, right? So your point, I totally agree with you. And I ran at one point ran a very panicked series of regressions to try to think this through, to convince myself that what I see in the historical record is true. And those things are going to be balanced, right? So the other key thing here is the skilled non-tradable employment share is balanced in 1930 across Bank of America and not Bank of America. Looking at these differences based on the different employment shares in 1930, is also going to be the same. So what that tells us, and I can control for them too. So it's like that it's not to say that agglomeration and diversification, all these things don't matter, but they are not going to be different between places that have a Bank of America and those that don't. And I have in the paper an exercise to show that the effects that I see on wages are not going to be driven by some of these other things. As well. So I think those things matter. And I think actually one of the things that's underpinning this reallocation thing really mattering is agglomeration, right? Like that there is this intensity of high human capital people working together in ways that are really only going to benefit the local economy. That has a lot of overlap with what we think of as sort of classical agglomeration, or I would think of. So I agree with you. And so I can show that these things aren't really affected by looking in small versus large places, or places with mostly agriculture in 1929, or places that have a more diversified economy in 1929. And again, maybe that sort of rings as funky. You're thinking about like, why is this bank doing this? And again, I just want to sort of emphasize that like, this is a bank that is operating in a constrained fashion. And so that's where these lack of differences are going to be coming from. So I hope that answers your question, because I totally agree with you. Those are really important things. And I think that they're important for understanding the Great Depression and what banks are able to do. It's just that I don't think those things are operating in this context.
Yeah, so, okay, I'm not going to push you on this, but acknowledging agglomeration effects is, I think, important in this, and also so that's one thing. The other thing is when you go to the skills. So again, in the table that appears in the text, at least table 1 with these statistics. So we have the OCC score, but that's not broken down by. So we don't, at least in the version I have, we don't see in this table. So it's kind of an aggregate average. You're looking at a median where a lot of the action on the high end is somehow obscured by taking a median, especially when you're talking about human capital and et cetera, where you have these long tails at the end.
Yes.
So at the upper end. So so again, if you could provide more detail there in terms of the paper itself, into the main table.
So those are in this is cruel to say this to you. That's Appendix F.
I didn't get all the way to Appendix F.
No one should, right, in their right mind. No, so there are way more balanced tables than are in the main text, because I think these things are really, like, I totally agree with you, right? Like the table that's in the main text is there as a summary measure, and then, for whatever sort of in your antenna sort of like perks you up, right? I want to convince you that the shares of these other things are not balanced. One thing that's actually, as I'm looking at it, not in there is I've done the HHI, like the Herfindahl Index of employment by industry and by occupation, and those things are also going to be balanced. So yeah, it's not in the main text, and maybe I should think about doing that.
Yeah, maybe. Yeah, so it definitely. Yeah, I'm scrolling down now to see. I'll take a look at it later. But in the text, you'll all the time, at least in the main text, you refer all the time to the OCC score, and that's kind of so yeah, maybe something there. And related to that, so what is the mechanism, the economic mechanism of that links bank intermediation to this human capital transformation or something? Because we would think that these investment in human capital started much earlier, let's put it this way. They're not so easy to kind of, so what's the economic mechanism driving this, not the statistical?
Yeah. No, so the story behind this, right? These are all going to be, I'm talking about people who are already in the labor force by 1930. I have a separate paper about sort of what happens to people entering the labor force in education in California in the 1930s. But what this is about is, I'm assuming their human capital investments are fixed and already done. The difference here is going to be whether or not they can use them. Right. And so I can't say, right, because I cannot observe this, right, whether or not this is because households are spending more, so retail and service places stay open and they can keep these higher human capital workers, or if it's because these retail establishments are able to get loans at more frequently at a Bank of America place than a non-Bank of America place. But regardless of whether it's supply or demand that's responding to these differences in credit, their labor demand is going to be different, right? In Bank of America places, there's going to be more employment in these non-tradable sectors in Bank of America places. And there's specifically, because of the overlap, I think what's going on here, right, is there's this overlap between then being able to keep, to stay open and to keep your more expensive, more productive workers in those jobs. So I'm not saying that like 25-year-olds are going back and finishing high school. I'm saying that these 25-year-olds are able to be hired in jobs or keep jobs that are going to use the skills they've already developed.
So we have just we're running out of the main block of time, but Carlos Costa wanted to comment to explain the different credit evolution among banks. It will be useful to distinguish between, my alarm's going off. Stop. Sorry, I set an alarm. That means it's time to stop, but I just wanted to finish what he was saying. To explain the different credit evolution among banks, it will be useful to distinguish between capital constraints and risk appetite or exposure of Bank of America and other banks.
Okay. So one of the things, so I agree. So I think what's going on here, right? So you can see that like Bank of America places are actually lending maybe at a slightly lower level than other banks in California over this time period. And then there's this deviation in the early 30s. But let me show you what's going on with their balance sheet. So in 1929, so if you get all of the balance sheets for all banks in California, you'll notice the Bank of America is both bigger. They are well capitalized, and they're holding most of their securities are in US Treasury bonds. And so I think, and again, I think this is totally worthy of a separate paper, and I'm collecting all of the branch and bank level balance sheets to understand what's going on in terms of risks here. But I think what's going on, right, is that because Bank of America is established, like has these beautiful economies of scale and economies of scope and all these things, right? They are able to sort of minimize their exposure to some things, right? Like they don't hold other securities while sort of allowing themselves to lend during the Great Depression. So to Carlos's question, I think it's a really important question. And I think that they are they are in some ways better prepared for the onset of a financial crisis because of the ways that they allocate their money. Beyond that, right, they also have they are able to move money around in ways that other banks are not. They're less exposed to the complete meltdown of the interbank market because they are their own interbank market. So there are going to be a couple of things going on here, which standard banking theory would suggest, and I see evidence for it, which allows Bank of America to sort of be small c conservative in sort of the ways that they're lending, while still offering more loans to more people during the early 30s.
Well, guys, we are out of time for the main portion of our webinar. I appreciate everybody's questions and attendance. And anyone who's interested in staying after class to chat and ask questions may do that.
So many fun facts about AP Giannini that I don't get to talk about. So,
is there a discussion of why he changed the name? That seems like a time. When was the exact date of the change?
So it's in 1930. They finally put all of his various little bits and pieces together under Bank of America National Trust Savings Association. But it's in the mid-20s, and it is definitely, I think, at least it's two things that motivate the change. One is this pretty aggressive anti-Italian nativism, racism, and the other thing that's going on is that he has aspirations for nationwide branch banking well before it becomes a reality. And so he's thinking to himself, this is going to happen.
I see
he's ready.
The idea that it's all of America, as opposed to, instead of naming it Bank of California or something.
Yeah, Bank of California was taken, but yeah. So in the 1931, there's these 1931 congressional hearings about branch banking, and that's where I get the pre-1931 branch level lending information. There's this Georgia senator is pleading, come here, we need you, and his colleague has to be buddy, it's illegal, he's not allowed to, you actually don't want this. And so there's this moment where in the early 30s where it seems like we're on the cusp of that happening. I think that there's another bill brought up by a California senator in the mid to late 1930s to nationalize or to make cross-state banking legal that gets shot down. But there was this real moment where it seemed like it might happen. And I think Giannini was ready for it. He was I'm the one who has figured out how to keep balance sheets for multiple locations. I know how to market these things. I know what I'm doing, right? He's the one who, in some ways it feels obvious to us from this perspective, of course, branch banking is useful, but I don't think it was at the time. And you see sort of after the 30s, other California bank networks really expanding because they have proof and they finally have the opportunity to.
Yeah. 100 years ago, I wrote a paper with a student comparing with Texas, because Texas was very late in allowing real estate. I think it was the late 70s.
Yeah.
Thanks, Sarah. Hi, Simone. Your in-depth knowledge of B of A pays off here. Will you be writing a paper about the depositors of B of A? That's Simone.
Oh, that's really interesting. So,
your appendix is to have a little section in the paper.
I was like, there's lots of footnotes in the paper to sort of point you, because it's a truly excessive number of tables, because I realize that the thing I'm looking at is maybe counterintuitive in terms of sort of believability, but I want to say, like, the perspective is that this is a constrained optimization problem, and like that's why these things are happening, right? Like, so it's like I realize I have to check all the boxes. The depositors are really interesting. I have a whole bunch of, I'm digitizing a whole bunch of stuff where I can actually look at the number of savings accounts by location and all this. So I like, yes, eventually there will be more on this, Simone. I'm really excited to look more at, try to understand who these people are, and sort of who actually are the little people, right? Little fellows. Bank of America's archives are like not really around anymore. So I can't like get into it too much. They sold them off apparently during the most recent financial crisis, and they're closed. That's I got this. So Mark Carlson and Chris Michener were writing this paper about banking branching in the 1920s, and they were on the cusp of getting access to this, and it was like during the financial crisis, and the B of A like slams the door on their face.
Oh no!
Yeah,
the archives.
Yeah, they're gone. They're like, they just have whatever lawyers told them they have to keep.
Lori has a question.
Yeah, sorry, were you?
Hi, Sarah. Thanks. So, I mean, this is a fairly obvious, predictable question, and you're probably going to tell me consult Appendix X.
It's the worst answer, I know.
But so it actually follows on Eugene's earlier question, right? So how would you estimate the aggregate effect, right? Maybe the general equilibrium effect. And it struck me that in the labor market, you find a positive effect on non-traded services. Mm-hmm. So it looks like having a helpful branch of the Bank of America close to you effectively perhaps turn these locations into service centers for the remaining region. The fact that you have an increase in high-paying skilled jobs also rhymes with this. Mm-hmm. So, the predictable part of my question is, what you do about contamination. So is it really that, this is a localized effect, or is just a reorganization of the labor force in the county, perhaps, rather than, and also whether you can control for migration. Yeah. And finally, I guess a different way of asking this is probably spatially autocorrelated. So, but how can we think about all of these?
So one of the cool things about using like data is I know where people were in 1930, and I can show that these things are the same. The effects are similar for people who were in California or in Bank of America versus non-Bank of America places. So regardless of where you started, you're still going to see these reallocation in labor effects. And so it's not being driven by migration. This is a different channel. And obviously migration is really interesting and important. It's just not, it doesn't feel like it's happening here in the same way. In terms of sort of becoming a service sector hub, that's interesting because I was almost thinking, I was like, if I did a back of the envelope thing, to me, this almost suggests that there shouldn't be a positive effect anywhere else because they're doing things that are internally focused, right? So part of maybe what's going on here is that it's like, we're no longer putting people who are skilled in jobs that are going to like, where they're going to benefit sort of other parts of the country. They're only going to benefit places that are nearby. And so maybe there isn't a positive spillover effect. One thing I do, because I geocoded all of the places people live, both rural and in cities in California, is that I'm actually using a proximity measure. So it's like, are you within 5 miles of Bank of America? I consider treated to try to think a little bit about what's going on with local labor markets, as you're saying. And what you see is that it does fall off, right? So I can actually just re-estimate that for like, you're treated if you have Bank of America. You're treated if you're within a mile of Bank of America, right? Kind of do that. And that is somewhere in the paper. And you do see that these effects fall off over time, or over space. And so that tells me, right, like there is the sort of, maybe it's a reallocation of workers, but that doesn't explain this growth of agriculture in non-Bank of America places. It can tell us about what's going on with services, but it doesn't explain the structural transformation reversal that non-B of A California places have and the rest of the country has.
Thank you.
Yeah.
Are there participants still on here who aren't? If anyone has questions, please let us know. While I'm waiting to see if anyone pops up with questions, of course, naturally, this makes me think of Germany, because during this time, there were a lot of parallel phenomena going on. And Germany
Yeah.
was an early branching system, starting already in, well, really, Deutsche Bank was the Bank of America of Germany. Appropriately, Germany Bank.
Yeah.
And so they started branching much, when they were founded, it was already on that principle that they would be a branch bank, and there were no regulatory restraints on branching or interstate. There's no unit banking. There are states, there were lender, there were no restrictions on that. They weren't super densely branched because it was just a novelty. It was just sort of a slow process, which is kind of interesting because in the US, we think of it as having held back what would have been a burgeoning branch system, which is maybe not the case if you compare to other countries.
Yeah.
Didn't prevent it, but still didn't have like huge branch networks. But that was something that boomed in the 20s. So that's a common phenomenon that's not unique to the US. So
And in France too, right? I think it happens in France.
As well. Yeah, I mean, all of Europe started doing more branching and more absorption of smaller banks. It was part of that concentration movement. The idea of economies of scale that came along in the largely after World War I.
Mm-hmm.
And so it might be useful, as Americans, we tend to think of California is to the US as the US is to the rest of the world, that accepts idea. And also it always makes me think of the work of Mike Bordeaux and Angela Reedish, who've done the work on Canada.
Yeah.
So it'd be useful to have just a somewhat maybe a broader view. Obviously this is not like rewrite this paper, but it's just.
Yeah, no, it's interesting because Giannini goes to Canada to get an idea of how do you keep balance sheets when you have this many places, right? Like he is very much like consciously looking to that. And I think it's Woodrow Wilson gives this speech in the late 1909. And he says like all these other countries are doing these things, like why don't we do it? And Giannini credits that, right, as saying to him, he wasn't a banker by training or by trade, he was a produce wholesaler. Yeah, and he basically starts a bank because he's Italian American, and the one bank in sort of the Italian section of San Francisco, he was like, you guys aren't lending to people. Like he was on the board, and so he goes, I'm just going to start my own bank. So he's coming at it from a different perspective, and he's very much, I think, looking to these other countries. And I think the Canadian example is particularly important because one of the reasons people were so scared of branch banking in the U.S. is that this idea of country money going to the city was super prevalent in Canada.
Oh.
And so they were worried that would happen in the United States, where all of the money would be funneled out of agricultural areas to make loans in cities, and we don't see that. And I think one of the reasons is it's like, like California, like people don't live out on farms. They live in cities and like little towns, and they commute out. And they're able to, and like they can charge a 1 percentage point higher interest rate if they lend in Davis, for example, as opposed to San Francisco. So if you feel confident in your lending technology, right, in your evaluation of people, then you can do that. But I wholly agree, right? Like it's interesting because they are, in some ways, Bank of America is really open to what's going on internationally and learning from them, but they're implementing it in I think maybe a setting specific kind of way.
We have one more question that's popped up. Emeric, I'm not sure how to Conry. I'm not sure if I pronounced your name right. So Emeric says, yes, I do have a question. Not sure if you can answer. The comparison between the 1929 depression and the current situation is limited, but we should take as lessons for the past to prepare an efficient and effective post-COVID recovery. So kind of how do you connect those or make that comparison, thinking about the 1929 depression, has important political consequences on the long term. So is there kind of a lesson for today?
Yeah. So it's interesting because you see in the in the Great Recession in the United States, you see these similar links between credit shocks and non-tradable growth. And what my paper suggests is that it's important to think about what the local economy is producing, right? But what also matters is the skill composition of those jobs. It seems like that intersection between tradability and skill can either prop up or not prop up sort of local labor markets. And so what I would take from this is to say, like, it's not that the same exact mechanisms are going to be happening, right? The kinds of lending that are done now are different than the kinds of lending that were done almost 100 years ago. But what matters, right, is that when we're thinking about the kinds of jobs that we need to incentivize creation for or whatever, we need to think really carefully about, like, who are the people who can be moved into those jobs? What are sort of the existing skill distribution, and how do we maximize sort of putting high skilled people in high skilled jobs, if that makes sense.
So that does raise this. So there's this theme of the urban rural divide and the underbanking of rural versus urban areas. But at the same time, that does raise the issue of underbanking within urban areas of the typically underrepresented minority communities, poorer communities within areas. Even though you can get there, you can't have an account there. So it's not necessarily geography or distance in a physical sense, but there is a distance in an economic sense.
Yeah, and it's actually, the Bank of America is a weird counterpoint to this in some ways, right? Like, so Giannini had this whole thing where he would drive around in his limo and like go to different branches in California and be like, let me see your loan applications. And if he thought people were only lending to like the local elite, he would like yell at them and tell them to go make the other loan. They're evaluating people on character, which I'm sure could be interpreted in a lot of ways that are problematic, right? But it's this interesting thing because one of like the whole motivation for his banking career in the first place is like, we are not making loans in a way that is reflective of this community. And he uses that to his advantage. He teaches people how to use checkbooks. They hire tellers who speak lots of different languages because what?
He wasn't super Italian focused because the name Bank of Italy that he started with, right?
Right.
He called it Bank of Italy.
Yeah, because he started in North Beach, right? So like that was the beginning, and then as they expanded, he was like, oh, there's like all of these like these like enclaves of immigrant community, like these immigrant communities that no one is serving.
My impression, I mean, like I said, 100 years ago when I was looking at this was that he started kind of focused on Italian immigrants.
Yeah.
He did broaden that out to a wider range of immigrant communities.
Yeah, there's a lot of really interesting sort of historical like work on sort of how do we think about like that they are hiring all these, they make a point to be open at hours that people who have other kinds of jobs couldn't make it, right? Like all these kinds of things. There's a lot of like great quotes where Bank of America is either an octopus of some sort or he's kicking off top hats. Like there's like depending on how you feel about the guy, you either are aggressively anti, he's a monopolist, or you're saying like this is, he fought for the little guy. He's like when he died, there were all these tributes from people who were like, this was my first bank. I learned all these things, like like a man for the people. And you're like, it's hard to imagine one person being both of those things to me, but getting access to financial services, obviously, it's not guaranteed in any context. And you're right. There's another way to think about interpreting this paper, which is to say that like having access to credit keeps certain jobs available. And if we think that keeping skilled jobs are important.
Yeah. Does anyone else have questions? Anyone? I don't see any questions popping up, but one last question I had is, there is a number 2 bank. And what is that in the 1920s? Because nowadays it would be Wells Fargo would be in California, right?
Yeah, it's funny. Wells Fargo, the network that takes the name Wells Fargo, right? Wells Fargo didn't really branch there. It's the combination of like Crocker and all these other guys who had started branching I remember which one. It's either Security First or Crocker are the second largest bank, but they're going to be much more, particularly pre-1937-ish, concentrated. It's like you're either in the area around LA and sort of the southern part of California, or you're in the area around San Francisco and specifically in parts of Northern California. So Bank of America is going to be larger than any of these banks, all these networks put together, but they're also different in the sense that they have constructed a network that actually goes up and down, right? So it would be hard to use the second largest bank because you would be comparing, I think, LA to the rest of the state, which is probably worse than comparing California to the rest of the country on some level. So it's interesting because these guys are really pushing back against B of A. And then they realize it works. And then by World War II, and certainly by the end of World War II, you see these networks have like really, everybody else's have expanded and they're much denser too, to really cover the state.
Right. Okay. We are out of time. We have to end.
Well, thank you for your questions. It was lovely to hear what people have to say. I appreciate it.
Rui, Rui and Nathan.
Thank you very much.
Thank you very much.
Right. Thanks for coming, and I'll see you next time.
Sounds good. Thank
Bye.
you, guys.
Thank you. Bye-bye.
Thanks, Freddie.
Sorry, I forgot to announce next week's